Probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice. Nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can like buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's like very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the years through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce. And he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy.
Connection
and
lost.
Need to, show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him, that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things, but you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaqi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Ina co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Ina and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He's making you, but you act for Nissan. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in Nissan for 16 years.
So Rav Pasi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Pasi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to a jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Passi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama Court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? This isn't a car company. This is not the KGB.
I think it's fair to say that Rob Posse didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. Amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil's going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37, and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they have done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way to the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know
Mr. Force,
which is declining in value.
You don't have enough of it, right, to power the world?
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP. And I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The S&P 500 index holding very close to session highs after wiping out a loss that hit 2%. The S&P is on track on this CPI Thursday to halt a 6-day sell-off that took it this morning to a 2-year low. So here's where we stand. S&P right now up 85, a gain of 2.4%. The Dow at 30,010, it is up 797 points. Dow Industrials up 2.7%. And NASDAQ up 207, a gain there of 2%. The NASDAQ 100 index up by about 2.1%. 10-year yield at 3.91%. The 2-year 4.40%. Spot gold down 0.1%, 16.70 the ounce, while West Texas Intermediate crude is up 2.5%, 89.45 a barrel. Stocks storming back from losses sparked by that hot inflation reading this morning. Reaction to the report from Mona Mahajan, senior investment strategist at Edward Jones.
Look, this is presenting a real challenge for not only the Fed, but the broader economy here. You know, inflation was supposed to be moderating. We were looking for 2 to 3, maybe 4 prints lower. In fact, today we got a print that is moving in the wrong direction.
Again, we've got the 10-year yielding 3.91%, the 2-year 4.40%. Delta Airlines sees profit in the final months of the year, outpacing Wall Street's expectations, lifted by a resurgence in international travel and the strongest recovery rates for corporate sales since the pandemic began. Airline stocks flying higher today. We have got Delta up by 4.6%, UAL up 3.9%, American up 3.1%, Southwest up 2.5%, JetBlue up now by 3.5%. Recapping, S&P up by 2.4%, S&P advancing now by 87 points. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, a very good afternoon, everyone. Live from the Bloomberg Interactive Broker Studio, streaming on YouTube. It is Friday's Eve, also known as Thursday, October 13, 2022. It's also known as CPI Day.
Did you see that number this morning?
Oh,
those numbers?
Yeah.
Just hotter than expected across the board. At first, stocks really seemed to care, but look, they are roaring back. We just heard the numbers from Charlie Pellet.
Yeah, I mean, stocks sold off, yields shot up, speak much, and now we've got kind of the other way. We've got stocks shooting up and yields backing off a little bit of their high levels. So we've got a lot to talk about. We're also going to talk about Netflix, a disruptor that's been disrupted. Will a coming makeover be enough? Some news today, too, on its ad-supported service.
Plus, 2 conversations from Bloomberg Invest. We're going to hear from Kathleen McCarthy, global co-head of Blackstone Real Estate, the largest owner of commercial real estate globally. You spoke to her earlier today.
I did, and then you had an incredible panel about Bitcoin and blockchain last night.
Yeah, we're going to hear from folks over who are handling digital assets and strategy at T. Rowe Price, Citi, and Susquehanna.
All right, we're also going to talk about key Senate races that will make or break President Biden's agenda, and then a really cool author who has spent a long time on Wall Street.
Yeah, the new book, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever, from a Wall Street insider.
Sounds kind of serious. Let's get to the Market Drivers Report. Let's set your Business Week agenda on this. Yes, it's Thursday, everybody. Kriti Gupta, anchor and markets correspondent at Bloomberg in our Interactive Brokers studio. Or Michael McKee, international economics and policy correspondent at Bloomberg News from our 99.1 studio in Washington, D.C. He has had a busy day. And I got to start with you, Mike. CPI print, it was hot, wasn't it?
It was hot. You know, I'm feeling right now a little bit like Godzilla to start destroying the city, and then you get shot down by all the warplanes. I don't know why the markets are up.
Author is going to come real soon.
Don't worry, Kriti's here, and she'll tell us what's going on with the markets. But you stick to the policy stuff, Mike.
This morning, the numbers told us that the markets should tank because, yes, we had expected maybe a flat to slightly down CPI, and instead both the headline and the core were higher than expected, and that tells us that inflation's going to be around for a while. We saw a drop in gasoline prices, which was kind of obvious, but we know that they're going to go back up again. And housing prices are really the problem here. They're up
0.8%. That's after several strong months of 0.7 gains. So they were accelerating in the month of September, and it takes a long time for them to get into and out of the CPI. So it looks like we're going to be living with this kind of high inflation until middle of next year or late next year, and it just solidifies the Fed's intention to keep raising rates aggressively.
Nobody needs shelter. No. Just
No.
that little thing named shelter.
Hey, well, we heard Mike say he has no idea what's going on with markets. He's not the only one, Creedy, because, at one point this morning, we're seeing significant declines across the board. Looks like it's going to be just a really, really bad day. And then suddenly, we start to see stocks shoot higher where they are now. I mean, the Dow up 2.8%, the S&P up 2.5%, the NASDAQ higher by 2% right now. What happened?
A more than 1,000-point intraday swing in the Dow. It is wild to see this turnaround story. A couple things have happened. Now, I couldn't point to one specific reason. I don't think anyone on the street could, but I'll give you a couple that are moving it. The first is positioning. When we got into the CPI report, we were already positioned for a super, super bullish reaction. So that's why you saw such a steep kind of decline, which is, I think we dropped like 2.5% or something like that on the headlines itself in futures trading. So to see a rebound it means like the 2.5% was an overreaction. That just has to do with positioning. So some of this is simply a fact of pairing that original loss. The second one is going to be what happened in the UK. When you got the headlines from, I think it was Liz Truss and the reporting here being that even though Kwasi Kwarteng, who's in DC right now, had said that they have no intention to turn around the plans, I think there was still some reporting that said that actually Liz Truss is actively looking at alternatives to turn things around. What that did to UK yields, and as a result, U.S. yields, kind of having that contagion effect, then pushed down the Treasury market and then the dollar, and therefore that would push up the S&P 500 as well. The third reason, and this is just a rumor, I don't have an actual source on this, but that some Russian newspapers were speculating, big emphasis on speculating, that perhaps Sergei Lavrov, the Russian foreign minister, and by extension Vladimir Putin may want to engage in talks. It's something that the U.S. has actively dismissed, and once again, it was just reports from local newspapers in Russia. So take that with a massive grain of salt, but altogether, this is what you get, a 2.5% rise in the S&P 500.
What incredible swings. All right, Mike McKee, so we got the memo, inflation's persistent. I mean, when you see these numbers, are we seeing any signs that inflation, though, in some regards, is topping out?
Well, we're seeing a few. We know that there was a big inventory build as stuff that was backed up in Chinese ports made it to the U.S., so retailers have big stocks that they want to sell down, so they've been discounting, and we saw apparel costs pretty much across the board in every category go down. We saw a few other things like used cars go down. We've been waiting for a big drop in used cars on a wholesale basis. They've done that, and we got a 1.1% decline. People thought we might get over 2%, so that might still be out there. Some of the things that we thought would decline did not, like airfares. We're past the travel season, but still airfares went up, which may reflect higher jet fuel prices. But those things might begin to turn around. The real issue is going to be shelter. Now, the Fed knows that shelter is a lagging indicator, so they won't necessarily make their policy on it, but they will be under pressure from Americans, as will the politicians here, because the numbers will still be high, even if we know it's a lagging indicator.
Hey, Mike, just in the last 40 seconds that we have with you, what ends up happening when it comes to what the Fed does in November and then what the Fed does in December? Are we thinking 75 basis points for each one, given today's print?
Well, we're definitely thinking 75 for November. That's pretty much locked in at the moment. And then we'll get another CPI report and another jobs report before the December meeting, so that will have an influence on what they do. The idea was to go 125 basis points more by the end of the year, which would be 75 and 50. But if they feel like they need to do more, probably in December, they would do that. But they'll wait to see what the data tell them before they make their final decision.
Meantime, Jamie Dimon, of course, the CEO of J.P. Morgan, commenting at the Institute of International Finance conference, I believe that's in Washington, saying his gut tells me the Fed rate will be higher than 4 to 4.5%. He does say the consumer could be strong, though, for another 9 months, so he's weighing in as well. Our thanks to Michael McKee, international economics and policy correspondent there in our 99.1 studio in D.C., and of course, Kriti Gupta, anchor and markets correspondent at Bloomberg.
Let's get to world and national news. Nancy Lyons is in our 99.1 studio in D.C. Hey, Nance.
Thanks, Tim. The January 6th committee is holding its ninth and likely final hearing, and Congresswoman Liz Cheney says they're focused on showing how Donald Trump pulled out all the stops to stay in power.
Today, we will focus on President Trump's state of mind, his intent, his motivations, and how he spurred others to do his bidding, and how another January 6th could happen again if we do not take necessary action to prevent it.
Cheney says those who plan to overturn the election must also be held accountable, but she says the committee is not ready to announce yet if it will be making criminal referrals to the Department of Justice. We are getting the White House's reaction to another hot reading on inflation, the last one before the midterm elections. President Biden put out a statement saying that progress is being made, but inflation remains a global problem. We spoke with top White House economic advisor Brian Deese.
The United States is in a better position than virtually any other country to address this challenge and do what is necessary to bring prices down without having to give up all of the economic gains that we have made.
National Economic Council Director Brian Deese. One positive side effect to inflation is that Social Security benefits are going up 8.7% next year. The cost of living adjustment, or COLA, is the biggest increase in 40 years. It'll amount to about $140 a month. In Florida, a jury has decided school shooter Nicholas Cruz will get life without parole for the 2018 massacre at Parkland's Marjorie Stoneman Douglas High School. Jurors said they could not unanimously agree on the death penalty. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. Got a story on the Bloomberg by Jordan Fabian that we wanted to bring to you, and this has to do with the White House accusing Saudi Arabia of coercing other OPEC plus countries into agreeing to a huge cut in oil production last week, really escalating a dispute with Riyadh over the move. Remember, we covered this a lot, this cut, although we were saying that some nations were already not producing at max capacity, so the cut maybe wasn't as big as everybody thought.
Yeah, don't forget about the fist bump what Biden had with MBS a few months ago when he went over there and tried to get Saudi Arabia to produce more oil.
Right.
The U.S. administration had asked the kingdom for a pause that would have effectively delayed expected price increases until after November's congressional elections. National Security Council spokesman John Kirby said in a statement Thursday that the administration had provided the Saudis with analysis showing, quote, no market basis for a production cut.
Yeah, Mr. Kirby going on to say other OPEC nations communicated to us privately that they also disagreed with the Saudi decision but felt coerced to support Saudi's direction. Again, that's a direct quote from National Security Council spokesman John Kirby. Saudi government suggesting yesterday that the U.S. had sought a 1-month delay of the decision, which would mean no production cut until after the U.S. midterm elections in November that will decide control of the House and Senate. Kirby confirmed the U.S. had sought a delay.
Yeah, President Biden and top U.S. officials have expressed outrage at the OPEC Plus alliance's decision to cut oil production by 2 million barrels a day, saying it will help keep revenue flowing to Russia to support its invasion of Ukraine. Some Democrats have also questioned the timing, suggesting that Saudi Arabia seeks to raise U.S. gasoline prices before the midterms to damage their party's prospects.
All right, so all of this is going on. If you look a little bit lower on this story, Biden said, you might recall this week, his administration would undertake a comprehensive review of its relationship with Saudi Arabia. There's no timetable to complete the review, and lawmakers, administration officials, and national security experts are split over how to impose consequences on the kingdom. To say it's a complicated relationship is probably to put it mildly.
It is, and you know, we have a great piece coming up from Stephen Dennis in just a few minutes. It's today's big take, and it's all about the Senate races to watch as what happens when it comes to midterm elections, which are, about a month away.
All right, this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Headquarters, I'm Charlie Pellet. The Dow, the S&P, and NASDAQ all surging. What a reversal for the U.S. stock market today. Got to keep in mind that the S&P, while it is up now by 86 points, up 2.4%, it managed to wipe out a loss that hit 2%. The S&P also on track to halt a 6-day sell-off. Stocks roaring back from losses sparked by that hot CPI reading on speculation the year-long sell-off has potentially reached a bottom. So again, the S&P up now by 2.4%. The Dow up 811, up 2.8%. NASDAQ up 204 now. That is a gain of 2%. We've got stocks at or near session highs. 10-year yield 3.93%. The 2-year 4.41%. Spot gold down 0.3%, 16.68 the ounce. And West Texas Intermediate crude oil is up 2.5%, 89.46 a barrel. Sources tell Bloomberg Kroger is in talks about a possible merger with rival U.S. supermarket company Albertson. They could reach an agreement as soon as this week. Right now, we've got Kroger up by 0.4%, Albertson surging by 12.2%. Recapping, 10-year yield 3.93%, S&P right now up by 2.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Is that like a special in aisle 3, Charlie?
I was just thinking that. What a deal in aisle 3. There you go.
I love when I can make myself laugh. All right, Charlie, or Charlie laugh. Charlie Pellet there, of course, with the Bloomberg Business News Flash. All right, you are listening and watching Bloomberg Business Week on this Thursday. Carol Massar along with Tim Stenovic. Charlie, of course, giving you some of the top business stories, the market run-up. We had a big, hot CPI inflation print earlier today. And then we've got, business as usual in Washington, and that includes the president making his way across the country to the West Coast.
Yeah, fresh off a visit to Colorado, the Vail area, where he went to Camp Hale and designated this area a national monument. He's now in Los Angeles, where he's expected to make some comments very soon on the bipartisan infrastructure law and also talking about the CPI report. So we'll bring those comments to you when he starts to speak.
Yeah, we'll certainly monitor and take you there as soon as it begins. In the meantime, there's something that's already important going on across the country, and you know it because we've got midterms coming up. And the Bloomberg Big Take today, also among our most read on the Bloomberg, about the 7 Senate races that will make or break President Biden's agenda. Bloomberg mapping out 3 plausible outcomes of the U.S. Senate after the 2022 midterms. If Democrats win big, President Biden could accomplish something no Democratic president has in decades.
Stephen Dennis is Senate reporter for Bloomberg News. He joins us on the phone from Capitol Hill this afternoon. Follow him on Twitter at Stephen T. Dennis. Hey, Stephen, okay, so a handful of really important Senate races to keep an eye on. I want to go through them one by one. I want to start in Pennsylvania because that one's been in the news a lot this week with John Fetterman and Dr. Oz. What do we need to watch for there?
Yeah, so we've got a big debate coming up October 25th. It's going to be their one debate, and Fetterman, obviously has been dealing with this stroke, which has impacted his ability to process speech. And so, his health has become a big issue in that race. And Mehmet Oz and his Republican allies have been really pounding him on criminal justice issues on the airwaves that have really tightened that race. So Fetterman has still been leading in the polls. But, that is a must-win race for either side. We've got a very close Senate. And, if you look at all the polls right now for all the Senate races, if you just took the polling averages, we'd end up with a 50-50 knife-edge Senate once again. So the Democrats really need that seat if they want to retain the majority.
And Steve, we just want to put out to you that we are monitoring the president, getting ready to make some comments. He is expected to talk infrastructure. He's out there in L.A. We're going to monitor and take you there as needed and as necessary, especially if he talks about today's inflation print.
Hey, Stephen, talk a little bit about not just the importance of what's happening here, but I think what's most interesting is President Biden's sagging poll numbers and the fact that we're even talking about Democrats being able to hold on to the Senate or even gain Senate seats. What gives here?
Yeah, so a lot of these Democratic candidates are polling 3, 4, 5 points ahead of Biden in their state. That's sort of defying political gravity, and it's one of the reasons why there's a real chance here for Democrats to defy history It hasn't been since 1962 that Democrats have gained seats during a midterm with a Democratic president. And there's a lot of issues that aren't really related so much to Biden, but to the environment. You know, we haven't had a situation where a 50-year popular precedent like Roe versus Wade gets overturned and causes a backlash and a huge wave of fundraising enthusiasm for Democrats. You also have a lot of Democratic incumbents who are experienced, have been very good at fundraising, and are against a lot of political neophytes who are somewhat untested and allied with President Trump, who have tripped up in a series of gaffes in certain states, and they're dealing with situations like Georgia, where Herschel Walker, every week there's another revelation about his personal life, accusations that he paid for an abortion, all kinds of things that you don't want to be talking about when if you're the Republicans, you want to be talking about Joe Biden and inflation. You don't want to be talking about abortion and some of these other issues like former President Donald Trump's claims about the 2020 election.
You mentioned these 7 Senate races. We've talked about Pennsylvania. Are they all really close?
These Senate races are all within about 4 points. And we know polls. It's very easy for them to be wrong by more than 4 points. Yeah. So these are the 7 that are within about 4 points each. And one of the things we wanted to do with this story is just point out to our listeners and our readers just how this could go either way. You have all these states, Nevada Senate race is within a point or two. There was a poll yesterday that had Cortez Masto up 2 points. The previous 5 polls had Laxalt up 1 or 2 points. And, it's a really hard state to poll because there's so many new voters every year in Nevada. It's a very transient state. That's right now the Republicans' best pickup opportunity. They really need to win in Nevada. And they need, people like Herschel Walker to sort of rally after some of these stories have come out and win, or else they're not going to take back the majority. And it's really key. I'll just say one name to remember is Merrick Garland. The reason why he is not on the Supreme Court and the reason why Roe was overturned is because in the 2014 midterm elections, Senate Republicans took back the majority and then ultimately didn't hold a vote.
All right, very important to keep in mind. Steve Dennis, thank you so much. Great story, and we appreciate it. Of course, he's Senate reporter at Bloomberg News, joining us on the phone from Capitol Hill. Let's go to Los Angeles. President Biden making some remarks on the bipartisan infrastructure law and also on today's inflation report.
And would you have a little left for some breathing room? Just a little bit of breathing room. And that's my view of what is important and critical. And a lot of people are hurting these days. Today's report shows, though, some progress. Overall, inflation was 2% over the last 3 months. That's down from 11% over the prior 3 months. And that's progress, but a lot of it is a result of getting the cost of living at the gas pump down by more, not even in California now, by more than $1 nationally. And since the start of this summer, there's a big difference for working folks. But the price of gas is still too high, and we need to keep working to bring it down. And I'll have more to say about that next week. We also need to make more progress bringing down the prices across the board. That's why I just couldn't disagree more with my Republican friends who say the biggest problem in our economy right now is that working folks are making too much money. No, that's the argument. Workers are making too much money and too many people are working. Too many jobs are being filled. I think that's a bunch, as we already said, a bunch of malarkey. The biggest problem is the world's challenge, global inflation and the pandemic and Putin's unconscionable invasion of Ukraine. Here's the deal. Because of my economic plan, we are better positioned than any other major economy in the world to weather the challenges that come through this as a stronger country. We've created nearly 700,000 manufacturing jobs just in the last 19 months. Businesses are investing here in America at record rates. They see what I see, the resilience of the American people and the potential of building an economy from the bottom up and the middle out. Look, when the middle does well and the bottom has a chance, the wealthy do very well. They never get hurt. I'm so tired of trickle down, I'm finished with it. So we're going to keep at it by taking on big pharma and the insurance companies, especially the health insurance companies. With the help of Democrats in Congress here today, I signed the Inflation Reduction Act, which gave Medicare the power that we've been trying to get for the last 30 years, the power to negotiate lower prescription drug prices. We pay the highest drug prices of any nation in the world. For seniors on Medicare, we're capping the cost of prescription drugs at $2,000 a year, even if they're using the most expensive cancer drug in the world. We're capping the cost of insulin, which is 30, 40 times higher than the number I'm going to give you, at $35 a month. You can't go higher than that. Folks, we're locking in savings and health care premiums for millions of people in the Affordable Care Act. And today, I'm announcing the Social Security benefits are going to go up by an average of $140 a month, even as Medicare premiums go down. So, folks, seniors are going to get ahead of inflation next year. For the first time in 10 years, their Social Security checks will go up while their Medicare premiums go down. Here's my final point. We've got an election in the month. Voters have to decide. Democrats are working to bring down the cost of things and to talk about around the kitchen table, from prescription drugs to health insurance to energy bills and so much more. We're standing up for working people and the right to get a raise and get a better job. Republicans are campaigning every day on an agenda to raise your costs. You know, I should point out before I go on, the Republican platform so far for this off-year election is led by a senator from
All right, you've been listening to President Biden there on the West Coast of the United States, Los Angeles. We're there specifically to really talk about the bipartisan infrastructure law investments on public transit, jobs, the job market, and opportunity. But he did, of course, address that very hot inflation print today, core U.S. inflation rising to a 40-year high.
Yeah, the president's saying people don't need a report to tell them they're being squeezed. He also said the price of gasoline is still too high and need to keep working. He said that he's going to address gasoline prices next week.
All right, so we'll continue to monitor and bring you any headlines as they come to our attention. In the meantime, a lot going on in the world of business as well as the financial markets. For that, let's turn things over to Charlie Pellet with the Bloomberg Business News Flash.
You got the right guy. I thank you very much, Carol Master. Here's what's going on. Do want to begin with some remarks from Jamie Dimon. He says the Fed is unlikely to engineer a soft landing for the U.S. economy as it raises rates to choke off inflation. Dimon is the CEO of J.P. Morgan Chase. He says central bank policymakers probably can't cool the red-hot economy without bringing on a recession. His remarks coming at an industry conference today in Washington. Stocks, though, storming back from earlier losses. What a day for the U.S. stock market, a swing of roughly 1,200 on the Dow from high to low. Right now, we're looking at a gain of 750 in the Dow, up by 2.6%. The S&P up 78, a gain there of 2.2%. NASDAQ up 177. That is an advance of 1.7%. 10-year 3.93%. The 2-year 4.42%. Spot gold down $5.50 the ounce to $16.67. Drop there of 0.3%. And West Texas Intermediate crude rallying 2%, $88.99 a barrel. Well, as for where this morning's CPI report leaves the Federal Reserve, Jenny Johnson is the president and CEO of Franklin Templeton Investments.
We are probably in a longer-term inflationary period for a period of time. The Fed has to get aggressive. They're afraid of what happened in the 70s by stopping raising too quickly. I think probably everybody, after seeing this number, is not only expecting the 75 maybe in November and the 50 after, but starting to look into 2023 and saying there'll be some additional hikes there as well.
Sources say sources tell Bloomberg Kroger is in talks about a merger with the rival U.S. supermarket company Albertsons, and the deal could come as soon as this week. We've got Kroger a little changed, up by 1 cent now. Albertsons surging by 11.8%. Domino's Pizza said better than expected quarterly sales are a further indication that even in the face of inflation, consumers are still indulging in their favorite meals and snacks. DPZ on the ticker there. We've got Domino's delivering a gain of 9.9%, and rival Papa John's International also advancing as investors devour That stock up now by 4.9%. Again, recapping S&P up 79, a gain there of 2.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Love me some pizza.
Me too. Friday night at the Master household.
That's right.
I was surprised, Charlie and Carol. 1/3 of all pizzas delivered before the pandemic were from Domino's. The company said today, and now they're back to that level.
Wow.
Isn't that amazing?
That's amazing.
Yeah.
Like, talk about owning the market.
Yeah.
All right, I have no good segue, so we're just going to get into our next segment. This past Monday, you all know this, and depending on where you were around the country, Columbus Day and/or Indigenous Peoples Day, and on the latter, the World Health Organization has noted that the health of Indigenous peoples is often marked by higher rates of health risks, poorer health outcomes, and greater unmet needs in terms of health and social services.
We've got Dr. Donald Warren with us, co-director of the Center for Indian Health at the Johns Hopkins Bloomberg School of Public Health. Dr. Warren joining us on the phone from Baltimore this afternoon. Dr. Warren, how are you?
Doing very well. How are you doing?
We're doing well, thanks. Hey, give us an idea of the health challenges facing Indigenous people in this country. What are you focused on at the Center for Indian Health at the Johns Hopkins Bloomberg School of Public Health, which I should note is supported by Michael R. Bloomberg, the founder of Bloomberg LP and Bloomberg Philanthropies?
Yeah, so we've had the Center for American Indian Health for over 30 years, actually. And the original work took place in Arizona in collaboration with a couple of the tribes who were facing some infectious disease issues. And at that time, there were children, very young children, who were dying from dehydration. So the original work was actually to develop oral rehydration therapy that eventually became Pedialyte, actually. So little known fact that Pedialyte actually originated out of that work.
Interesting.
Through the Johns Hopkins School of Public Health in collaboration with tribes in Arizona. And since that time, over the last 30 or so years, they've expanded the work to well over 200 tribes across the U.S. and expanded beyond infectious disease to include things like maternal and child health, as well as addressing behavioral health considerations and chronic disease. So we just recently, within the last less than 1 month, changed the name from the Center for American Indian Health to the Center for Indigenous Health, and we'll be having more of an international focus moving forward.
Talk to us about Indigenous communities in the U.S., in the United States, or even globally. Why is it that they're having such a tough time in terms of access to good health care and having good health outcomes?
Well, each population is different, but there are some commonalities. And when we look at the indigenous populations, those are the first inhabitants of various parts of the earth. And of course, for the United States, that would include both American Indian and Alaska Native populations, as well as Native Hawaiian and other indigenous peoples in the Pacific Islands that are in U.S. territories. So we have a very diverse group of indigenous peoples in the United States. But specifically for American Indians and Alaskan Natives, what really makes us unique is that we have sovereign nations within the United States. So there's actually 574 federally recognized sovereign tribes. So we have our own elected officials, our own governments, in many cases our own health systems. But the big challenge is that we face terrible rates of poverty and marginalization in many of our tribes. So one of the things that we see across populations served by Indian Health Service is a lot of poverty-related illnesses and other socially determined health disparities. And unfortunately, the Indian Health Service is terribly underfunded. And if we look at just the funding for IHS compared to Medicare, for example, IHS is funded about $3,000 to $4,000 per patient per year. Medicare is funded at $12,000 per patient per year. So we just have a terribly underfunded health system coupled with an impoverished population, generally speaking.
Dr. Warren, can you talk a little bit about your bio and you know, from what I've read, this, you know, medicine runs in your family. Can you talk a little bit about your background and how you bring a traditional approach to what you're doing today?
Absolutely. So I'm Oglala Lakota, originally from Kyle, South Dakota on the Pine Ridge Indian Reservation. And I was very fortunate to grow up in a family with a lot of traditional healers and medicine men. So several uncles, and I had a grandfather who were all traditional healers. And I've learned a lot about traditional Lakota approaches to health and wellness just from my own family. And it's also a ceremony family, so we have sacred ceremonies that we participate in every year, and really hanging on to the beauty and the benefits of connectedness to traditional culture. In addition to that, my mom is a nurse. She's 83 and still working. I like to tease her that she failed retirement because she tried to retire. And she's still working as an educator and really helping to educate the next generation of American Indian nurses. So I've been exposed to the whole field of healthcare from traditional cultural perspectives as well as modern medical perspectives. And then I was very fortunate. I did well in school and was able to go to Stanford for medical school and Harvard for my Master of Public Health.
I've got to ask you, we've only got about a minute left, so this is not an easy thing I know to answer, but I mean, it feels like another population in the United States that gets an incredible raw deal, and indigenous people over and over again, you know, you can pick your point, is being left behind. What big program or policy change could we do that would make a difference on the population in the United States specifically? I'm asking, we've got about a minute.
Yeah, and in the U.S., one of the unique considerations is that most of our tribes also have treaties with the federal government. So there's a government-to-government relationship. And as part of those treaties, it's well documented in case law and in other examples that we have a legal treaty right to health services in the United States. So the only thing that we would ask is that the federal government live up to its treaty obligations, much in the same way we would criticize other nations for not living up to their treaty obligations. We should actually be looking at our treaty obligations to our indigenous peoples in the U.S. and recognize that underfunding the Indian Health Service really is a breach of those treaty obligations.
Very interesting and informative. Dr. Donald Warren, thank you so much. Really appreciate your time today. Co-director for the soon-to-be Center for Indigenous People at the Johns Hopkins Bloomberg School of Public Health Center for Indigenous People's Health, I should say. And of course, Johns Hopkins is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Dr. Warren joining us on the phone from Baltimore. And we just want to mention, be sure to check out, too, we've got a podcast here at Bloomberg. Rachel Adams Heard, it's called In Trust, and they've been investigating a transfer of Native American wealth, and you can find that at Bloomberg.com or wherever you get your podcasts.
Let's get over to world and national news now. For that, we go to Washington, D.C. and our 99.1 newsroom where we find Nancy Lyons. Hey, Nance.
Thanks, Tim. Well, the House committee looking into last year's attack on the U.S. Capitol is taking a brief break. Committee members have been summarizing the evidence they've collected. Congresswoman Elaine Luria of Virginia this afternoon spoke of former President Trump's efforts to find votes in Georgia.
I just want to find 11,780 votes. That's an extraordinary demand by the president, especially since he already knew from the Justice Department there was no genuine basis for this request.
Again, Congresswoman Luria. Today's hearing is the committee's 9th and likely final hearing before releasing a report with recommendations. There are reports, though, the committee may vote today on whether to subpoena Trump himself. The midterm race for control of Congress is getting tighter.
A new CNN poll shows 50% of voters prefer the Democratic candidate in their congressional district compared to 47% for the Republican. In competitive districts, though, it shifts the other way. 48% of likely voters prefer the Republican candidate in those tight races. 43% go for the Democrat. The poll finds 32% of voters think Republicans have a clear plan to solve the country's problems. 28% say the same about Democratic candidates. In Washington, I'm Nathan Hager, Bloomberg Radio.
A jury in Broward County, Florida, decided not to give the death penalty to Nicholas Cruz, the gunman convicted in the Marjorie Stoneman Douglas High School shooting in Parkland, Florida, 5 years ago. Instead, Cruz was sentenced to life in prison without parole for the deaths of 17 people in that shooting. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right. Hey, Nance. Thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. So check out, shares of Netflix charging ahead, up more than 4% in today's session. Just a couple of hours ago or so, we got some headlines crossing. Netflix will introduce an ad-supported plan on November 3rd. We knew it was coming.
Yeah, we knew it was coming. We didn't know how much it would cost or where it would go.
Now we know what it costs.
Yes, $7 a month. You gonna downgrade to that?
I don't know. We're getting to a point where we have so many different streaming services. It's kind of back to cable, I feel like.
That is so true.
And then at some point we're going to have to be like, do we really watch this?
What's old is new again.
Yeah. I mean, Netflix was the market leader, the innovator,
streaming.
right? The disruptor. So we shall see. But the company's making some new big bets to entice new budget-conscious customers and jumpstart growth. This is really about kind of juicing the top and bottom line for the company.
Oh yeah, this is huge, and it's interesting. Investors are reacting positively to this, but Netflix shares are just beat up this year after it reported in the first couple of months of the year an actual decline of 2 million customers. We're going to have more on this with Lucas Shaw in just a few minutes. In the meantime, some more details on this. This lower price streaming package, it's going to debut here in the U.S. on November 3rd, also in 11 other countries, including Japan, France, Brazil, and a few others. 4 to 5 minutes of commercials per hour, Carol, and offer a lower video quality than higher price tiers. The lower video quality thing is something that Netflix has experimented with in the past with its full price packages. So if you wanted, 4K or I think it was 4K, you would pay a little more.
So check it out. There's a great little chart in the Bloomberg story. So basic with ads is $6.99 a month. Basic is $9.99. Standard, I'm not quite sure what that means, $15.49. That gives you a number of screens you can watch at one time, so that would give you 2. Premium lets you watch on 4 screens at one time. That's premium, and it costs almost $20 a month.
And you get Ultra HD.
Woohoo!
I want to see what they do with password sharing.
Yeah, we're going to talk about our Lucas Shaw, who put this story out on the terminal. He's got a great story in Bloomberg Business Week. We're going to talk about the new Netflix. That's coming up next on Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Big bounce for the U.S. stock market, holding on to gains. Going to be very interesting to see if the Dow Jones Industrial Average can hold above 30,000. Right now, 30,050 on the Dow, up 2.9%, up 837 points. The S&P up 89, up 2.5%. We've got NASDAQ up 208 now, higher by 2%. Stocks came roaring back from losses, sparked by a hot inflation reading on speculation. The year-long sell-off had potentially reached a bottom. The 10-year yield, 3.93%. Spot gold right now, $16.67 the ounce. The 2-year, by the way, 4.43%. And West Texas Intermediate crude up 2% now, $89.03 a barrel. So today, CPI Thursday. Tomorrow, banks. Friday, we'll be hearing from J.P. Morgan Chase up 5.2%. Citigroup tomorrow up 5.3%. Wells Fargo up 4.7% now. Morgan Stanley up by 3.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Got it. Great. Charlie, thank you so much. Well, we just talked about Netflix coming out with its tiers in terms of its ad-supported streaming service.
T-I-E-R-S. Not tiers like earlier this year for Netflix.
Oh, okay.
Yeah.
Like those tiers?
Yeah, I mean, that was happening earlier this year.
I know. People are like, what?
Yeah, what's going on?
Ads? Netflix? Okay. So we mentioned that's going to launch that ad-supported plan on November 3rd. That story was reported by our Lucas Shaw, as is a most read on the Bloomberg. That is in the new issue of Bloomberg Businessweek magazine. And that story about Netflix's coming makeover in the face of some real streaming competition.
Yeah, the piece by Lucas Shaw, entertainment reporter for Bloomberg News. He joins us on the phone from Los Angeles. Give him a follow on Twitter at Lucas_Shaw, and then sign up for Screen Time, his fantastic newsletter. Lucas, good to have you with us this afternoon. I want to go back years ago to sort of the DNA of Netflix, the way that it disrupted Blockbuster, but then kind of had to disrupt itself when it really brought streaming to the masses. Because I think that's a big part of your piece, because Netflix, once again, in order to succeed in this new ecosystem, has to disrupt itself one more time. Where should we start?
I mean, you can start with advertising, which is where we started earlier, because it's something Netflix has always said it would never do.
Never say
being
never.
An ad-free, being an ad-free streaming service was sort of the core part of its proposition, something that made it better than cable TV, where people were overwhelmed with 10, 15 minutes of advertising per hour, and is really a sign of kind of the, maybe not desperation, but the challenge they face here, where they've just hit a wall in terms of growth over the last 18 months and are now doing two things, both advertising and charging for password sharing, that they long said were not an issue. The one quibble I take with the comparison to starting streaming, which I think is totally valid, is that if you asked the leadership of the company, they would argue that this is more of a minor alteration because they still believe in streaming. They're just making some changes to it. But that is, of course, a little bit of corporate spin.
Joel Weber's here, the editor of Bloomberg Businessweek magazine, and it's a really timely story considering the headlines we got earlier today about Netflix launching that service, and we got some details on how much it's going to cost, Joel.
Yeah, so Lucas, the thing that I just wanted to spend a little bit of time talking to you is the culture at Netflix. And Saranda's obviously been there for a while, has been the architect of sort of the content strategy. The thing that, like we say in the story, he never wanted to do was ads, right? And so internally, I'm really curious to see how they tested the price of this model. Like, what's your early sense of just like, how did they land on this particular price?
Well, I think the price comes from mimicking other services. They don't like to say that out externally. There was a call earlier today where a reporter asked Greg Peters, the COO of the company, if they chose $6.99 a month because it's $1 less than Disney Plus's ad tier, which is $7.99 a month. And they said no. But I've had conversations with people at the very top of the company who said that they were modeling it a little bit after Hulu, which was sort of the first big streaming service to offer ads, one of Netflix's earliest competitors. And it's priced in a way where they believe the $6.99 a month, $7 a month, plus what they'll make from advertising means that they'll make as much, if not more, from an ad tier customer as they will from the premium one, to your question about culture, I just think this year in general, the past couple of years have been very destructive towards a culture that was pretty unique in business.
Well, stick with that, because one of the things that you talk about was I would call it a debacle, which was the Quickster moment, where they said, you know what, we're going to change the name, and we're going to turn the streaming thing into Quickster, and it did not go over well. But it speaks to this company's ability to sort of try things. Maybe you soft launch something, it doesn't go well, and you pivot, and boy, that last decade since the Quickster thing looked really good. But one of the things you point out in the story is that there's not that many people left at the company from back then.
Yeah, I mean, you have to give them credit to your point about Quickster with the advertising and the password sharing. They're moving very quickly. I mean, they went from, at the end of last year, still not thinking they were doing advertising, to standing up an ad service in less than a year. They're doing it faster than Disney got their ad-supported tier out there. And keep in mind, Disney already has an ad-supported service in Hulu, and Disney is a major player in video advertising. So there is a degree to which the company can still move incredibly quickly, and I think that's a credit to Reed Hastings and Ted Sarandos. But a lot of the senior leadership around them has left. There's just, in general, a lot of restlessness among employees. And I think there was a feeling for a long time that, Netflix was the place to work if you wanted to be in media, and in some cases in tech. I mean, it was at the top of like every list of most desirable company. And it's not like it's completely fallen off, but for a lot of the folks who work there, it now feels like another company, because there was forever this very unique culture that Reed Hastings had built and written a book about. And while it's still there in pieces, it has kind of fallen to prey to the same thing that all companies do as they get scale. They traditional.
So what has stuck around from that infamous culture deck that kind of went viral years ago? The idea, the company is like a sports team, not a family, right? They'll cut people who aren't top performers, but at the same time, they encourage you to go out and see how much you're worth in the marketplace and come back, and you can get a raise from Netflix that way. I mean, what parts are sticking around to you, and what parts are kind of gone there?
I mean, I'd say it's a moderation of things, right? So the company is infamous for having radical transparency. Reed Hastings modeled a lot of his leadership off of Ray Dalio, the Bridgewater guy. And that comes in a couple forms. It's a lot of feedback, so people being very direct and blunt with one another, and also then sharing metrics and data. Netflix makes the pay available to, employees can see what one another is making above a certain level. They share their financial results weeks before they announce them publicly with hundreds of employees, which is very rare. Some of that is still sticking around. They still share some of those financial results ahead of time. They do still have the pay available to some. But you talk to employees and they say that a lot of the decision-making, which used to be decentralized, it used to be you wanted to empower people who were, VP level, relatively mid-level executives to be able to buy a project or try something. That just doesn't happen as much anymore. A lot of the decisions seem to be made by a few stakeholders, and people are just playing with fear more because the company is under more pressure.
Hey, just got about 30 seconds left here. I love this line, though, in your story. With all of this going on, you say it's important to note that in some ways Netflix has never been stronger. 20 seconds, why?
It's profitable. It doesn't have to borrow money anymore, and it is far and away bigger than all these other companies, which are dealing with the decline of cable TV, which does not affect Netflix.
Which, Lucas, thank you for this story. Perfectly timed. I mean, you think about all these other companies that are basically going through the growing pains that Netflix has gone through. Netflix built its dynasty on cheap debt, and they're profitable and know how to do this. It's like, to some advantage, there's a serious advantage there.
Yeah, it's a great deep dive into so much when it comes to Netflix and the changes that it's making. It's like you knew something was going on, and there'd be some headlines here, Joel.
I mean, I get to work with people like Lucas. It's amazing.
He is amazing. Lucas Shaw is entertainment reporter at Bloomberg News from LA, and of course, the editor of Bloomberg Businessweek, Joel Weber, here in our studio. This is Bloomberg Radio.
to the Close, Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, joined now by colleagues Carol Massa and Tim Stenovic. We together go across our audiences of TV, radio, and YouTube to, well, decide that this is a very volatile day with heavy volumes and many people trying to interpret the turnaround.
Pulling out all the textbooks to try and figure out the trade in this one. We'll get into that in just a moment. Having said that, talk about continued outperformance among those airlines. If you bring up the S&P Super Composite Airlines Index for a TV crowd, you can see that index is up about 3.6%. But go through the names. You've got Delta up almost 5%, United up more than 4%, and American up about 3%. You did have Delta reporting today. They see fourth quarter profit outpacing Wall Street's expectations thanks to corporate travel is coming back. And this is even as costs remain elevated and economic volatility lingers. We're going to hear more from the airlines next week.
And we're finally seeing a good day for semiconductor stocks. Look at the stocks today. It's up close to 3%. It's outperforming the S&P 500 and the NASDAQ. It was down as much as 5% earlier in the session, then up as much as 4.6%. I was going to get to that, Carol.
I just was doing an assist.
Okay. Well, some context there, okay? It's down 42% this year.
Carol with the
context. About time for a good day for the stocks, right? Qualcomm, NVIDIA, TSMC, Lam Research leading it higher. Everything in there is in the green, actually.
Well, I mean, every benchmark, major benchmarks in the green as well. It's interesting that you point out the chip stocks. And in fact, it's not the NASDAQ that wins out on the day, but it is the good old Dow Jones, up more than 3% on the Dow Jones Industrial Average. We're at 30,096. Romain cracks his hat back out. We've got the NASDAQ up 2.2%. We've got the Russell 2000 up 2.45%. That's basically 41 points to the higher side. The S&P now almost up 100 points. We're up 2.7% on that benchmark.
And it is a breath kind of day for Romain. Only 23 names in the red. And so it's green across the screen on all the major indices as well. And I count about 5 of these sectors, Romain, where 100% of the securities in the sectors are also green on the screen. It's energy, it's financials, it's also technology up more than 3%.
Technology up more than 3%. That's been a little bit resilient. You're looking at Apple shares, which at one point on the day were actually down as much as 3%, now higher by about 3% in this flip-flop of a day. But two interesting things to keep an eye on. We did hear from A.O. Smith, which makes water heaters and a lot of the stuff that goes into homes. They actually were a lot more cautious here about the economy going forward. And in fact, those shares had been down as much as 5%. They're higher now by about 0.2%. But they actually did drag down a good portion of the rest of the building sector here. And I think that's something to keep an eye on as we get this CEO commentary and get a little bit of insight as to whether they think their businesses can hold up. We did hear from the CEO of Domino's Pizza, and he said, you know what? Everybody's still buying pizza. Nobody ever stops buying pizza. In fact, the great quote was, he said, before the pandemic, 1 in every 3 pizzas sold in the U.S. was Domino's. He said, right now, 1 in every 3 pizzas sold in the U.S. is Domino's. I don't know if that's a good or bad thing, but if you're a Domino's CEO or Domino's investors, it's good. Those shares up 11%.
You know what goes well with pizza?
No.
Football, Romain.
Oh my gosh.
Oh, don't start to
turn into a little
again.
You were going to say wine or beer. Come on.
No, she's vegan. I thought you also didn't eat any of the flour in pizza. Meanwhile, she's just sucker for sports. Let's look, though, at the sport of how companies manage this inflationary environment. And to your point, Romain, you're going to hear from CEOs, the earnings are going to be so important because this chart shows the S&P 500 under pressure, clearly in the blue line for our radio audience sinking. But so too, therefore, slowly but surely, the margins getting hit. High input costs are taking forward margins sharply lower, but clearly not affecting your pizza input.
Exactly. Hey, I got to just say one thing. The 5% swings in the S&P and the Dow, I just don't get it. And because you've got now the VIX down more than a point, I don't understand it. With
and you got a 2-year yield higher by 16 basis points right now.
I said.
So add that up.
Let's just go eat pizza and watch a football game or something. Yeah. All right. So obviously, everybody's trying to make sense of the inflation print that we got today. And our TV team caught up with Brian Deese, director of the U.S. National Economic Council, who talked about the shelter costs, which alone rose 0.7% in September from the month before. Here's what he had to say.
Shelter inflation represented more than half of core inflation for the last couple of months. And we're seeing some contemporaneous real-time evidence of sharp deceleration in rental price appreciation, sharp deceleration in home price appreciation. So that's going to be an area that we're going to have to stay very focused on here in the days and months ahead.
And that's, of course, Brian Deese of the U.S. National Economic Council Director. You know, Mike said something interesting to us, you guys, and he talked about that it takes a while for housing and shelter to get into the CPI, and it takes a while for it to get out. It's a lagging indicator. So it's just something to think about in terms of the stickiness of it, potentially, and the lagging aspect of it as well.
Yeah, but the problem is the stickiness of it. The problem is that this was higher across the board. It doesn't matter if we were talking about core or non-core. It doesn't matter if we were talking about month over month or year over year. Everything was above expectations, and it just makes us think about what happens in December. And look, we do get more data before the December Fed meeting, but I mean, it's not even worth actually thinking about what the Fed is going to do in, November, because we've got the data.
Yeah, and Rick Rader came out with a great tweet, basically saying 75 basis points. It's pretty much locked in, particularly after this report. I think I'm probably one of the few people out there who actually thinks that some of the focus on the shelter costs is a little bit of a red herring, and it kind of deflects, I think, from some of the more painful areas. Because remember, that step up that we saw in shelter costs, it was a lot more gradual. Meanwhile, the real inflationary shock came in a lot of the more essential goods, primarily in the food sector. And the fact that you're now seeing a reacceleration in some of those prices, that has a material impact because, again, it's not about the headline number two, but it's also about expectations, consumer expectations. And if those are still high going forward, I don't know what the Fed's going to do to actually get them down.
And again, we'll talk about break-evens, which have actually since March felt pretty well anchored. And that was the sign that the Federal Reserve's talk, and of course then the lag on some of the actions were working. But then I'm hearing more and more market participants saying maybe we don't believe the break-evens, that we're actually not sure that even 2.5%, 3.5% in the coming years is actually now even realistic. So that also could be the debate about long-term, is this sort of inflation anchored or not?
And what does it mean when you're trying to bargain with your employer for higher wages? Real average hourly earnings dropped again in September. That's from the jobless claims. Are you going to be out there saying, I need a match to this, and therefore is some of your wage spiral and stickiness, Carol?
Let's not forget, too, in those FOMC minutes that we got yesterday, that the members reminded us that the Fed rate hikes haven't played their way through all of the economy. So they did kind of say, hey, we know inflation is still high, and yet we've got to kind of wait for some of the rate increases.
How long does it take, though? I mean, we basically started this in March, officially.
We've seen it in
and the
housing
jawboning started at the end of last year.
Yeah.
So
And Rick
what's the
Reader-
lag? How long is this lag?
Rick Reader in his notes saying we're a little, I mean, not surprised that this is a big lag, and that we all thought that we were going to start to feel it by the fourth quarter, that the March would be felt by Q4, and if we're not feeling it now, does that mean it's more entrenched? Why has there been such a lag?
If you're trying to buy a house, you're feeling it, right? Like that has certainly played out. We're just waiting for other aspects.
We get freeze there, aren't we, Ron?
Yeah, well.
All right, say goodbye, Carol.
All right. Okay, Roland. All right, we will be back in less than an hour's time. We're going to continue this conversation on radio, TV, and YouTube. Beyond the bell, we're going to count you down to the close on this Thursday. Does that work for you, Romaine?